Well, over the past 6 months, Bitcoin has grown nearly 5 times faster than stocks, with 38% growth versus 8% for the S&P 500. As any Bitcoiner will tell you, it's hard to beat Bitcoin over most timeframes. So it may seem unbelievable, but in today's income ETF power rankings, I'm going to show you 10 ETFs that are growing more than twice as fast as Bitcoin, and 5 of them are growing over 3 times faster. If you like earning passive income while you sleep, then hit that like button, buckle up, and let's get started. Well, if you missed it, watch my video where I introduce the BitBagger Income ETF Blended Power Rankings and explain why they're needed and how they're calculated. But briefly, these ETFs strike a balance between recent performance and reliable track record while filtering out distractions of NAV erosion, distribution rate, and payment frequency. Each ETF is ranked by their blended average annualized performance, looking back 6 months based on total returns with distributions reinvested. The 25 funds in our rankings have been curated from the best offerings of YieldMax, Roundhill, and Neos fund families. And for comparison, we've included some of the top S&P 500 and NASDAQ-based funds. These high-powered funds are generating their massive income by selling covered calls on some underlying stock or basket of stocks. Remember, you should only invest in these ETFs if you're bullish on the underlying, which I list in the rankings table. Apart from the major stock index-based ETFs, our worst performer saw an average gain of 12% annualized, with our top performer seeing a whopping 139% annualized. Lastly, all of these pay distributions at least monthly, with 9 of them paying weekly. But enough talk, let's unveil this week's rankings. This week's rankings account for total returns with share price and distributions received through August 21st. At the number 1 spot for the second consecutive week is weekly pair PLTW by Roundhill, based on underlying Palantir stock. PLTW is far ahead of the pack with a blended average performance of 139% annualized, which means you would recoup your cost basis after just 9 months. But this turbocharged performance does not come without risk. Remember, you should be bullish on the underlying Palantir if you decide to hold PLTW. Palantir stock has been on fire and currently up 400% from a year ago. Its PE ratio, which reflects investor hype over the stock, is currently in the stratosphere at 529 compared to a 30 average for S&P 500 stocks. The market is valuing Palantir at about 18 times the S&P 500 average. With that whopping valuation, some fear that Palantir stock may be due for a correction. So be sure to do your own research and adjust any allocation you make to PLTW accordingly. And with the number 2 ranking, also for the second consecutive week, is another Roundhill offering, NVDW, with a 106% blended average performance and 11 months to recoup cost basis. You might consider this if you're bullish on underlying NVIDIA, which is up 38% from a year ago and has a relatively tame PE of 57 compared to Palantir's 529. Now coming in at number 3, we have our first YieldMax offering, PLTY, with a blended average score of 93% and 13 months to recoup cost basis. You'll notice that just like number 1 PLTW, PLTY gives you single stock risk exposure to Palantir stock. So there's some important differences between these two that you'll want to be aware. So first, let's look at the number 1 ranked PLTW from Roundhill. And PLTW is one of their 15 weekly pay ETFs. In fact, it's their largest one with $140 million of assets under management. And if you look at the Roundhill prospectus for PLTW, it uses a leveraged investment strategy that seeks to provide a weekly return of approximately 1.2 times or 120% of the calendar week return of the Palantir stock. It warns that the fund presents risks different from other mutual funds and ETFs. The fund is riskier than those that do not use leverage. So that's a key word here. This fund tries to use leverage to magnify the performance of PLTR. And what that means is when Palantir stock pumps, then the PLTW fund is trying to pump 1.2 times harder. And if Palantir stock dumps, then the PLTW fund could be expected to dump 1.2 times harder. The fund is not suitable for all investors. It's only suitable for knowledgeable investors who understand this point on how it operates, and they want you to actively monitor and manage the investment. So that's just a note about the Roundhill weekly pay ETF. And this table shows you some of the differences. So then YieldMax's PLTY has a primary goal of high monthly income using a synthetic covered call strategy, whereas Roundhill's PLTW is aiming for amplified weekly returns because of its 1.2x leveraged exposure. And you can see below the upside potential is 1.2x, but the downside is it could dump 1.2 times harder, magnifying your losses. So just a warning, if you want the insane growth that PLTW represents, then you're going to want to monitor it a little bit better. And you definitely want to be bullish on Palantir stock rising, because if Palantir stock dumps, PLTW could dump harder. Now, how does this play out in practice? Let's look at the performance of the underlying Palantir versus these two funds over the past 6 months. So looking back over the past 6 months, Palantir stock has grown 56.6%, while the Roundhill PLTW has grown 14.4%, and YieldMax's PLTY has actually dropped 23.3%. And that's looking just at share price. Now, when you look at distributions, of course, the Palantir stock doesn't pay any distributions, but PLTW saw 47% growth from distributions, and PLTY saw 56% growth from its distributions. Now, with the distributions, Palantir saw 57% growth, PLTW saw a total 62% return, and PLTY saw a total 33% gain. Now, you can see that PLTY had higher distributions than PLTW, but because PLTW did not lose share price as much as PLTY, the total return was actually better for PLTW. And furthermore, PLTW outperformed the underlying Palantir stock versus PLTY underperforming Palantir. And while PLTY has a target of 1.2x on the weekly performance of Palantir, that doesn't apply for a 6-month period. It's still nice to see that over 6 months, they did outperform the underlying Palantir by 1.1x versus PLTY, which underperformed Palantir with a 0.58 multiple. So that gives you an idea about how these Roundhill leveraged weekly pay ETFs can operate. And let's go back to our rankings. And at number 4, we have COIW, which is another Roundhill weekly pay ETF. And this one is based on Coinbase. And it saw a blended average performance of 80%, which means you would recoup your cost basis in 15 months. Now, since it's based on Coinbase, you would only want to invest in this if you're bullish on Coinbase. So for comparison, Coinbase stock is up 51% from a year ago and has a PE of 31, which is almost exactly the S&P 500 average. Now, at number 5, we have our second YieldMax offering, NVDY, with a blended average of 74% and 16 months to recoup your basis. This one is based on underlying NVIDIA and uses a straightforward covered call income strategy without the 1.2x leverage that Roundhill uses for number 2 NVDW. Now, if you want to avoid single stock risk, number 6 OARK by YieldMax is our highest rated pick with diversified underlying. This monthly pair is based on Cathie Wood's popular ARK Innovation Fund and produces a blended average performance of 61%. Rather than being bullish on a single stock, you should be bullish on ARKK Fund, which holds innovation plays like Tesla, Coinbase, Roblox, Roku, and CRISPR. At number 7, we have ULTY, which is a very popular YieldMax fund with 57% blended average performance and our second highest pick if you're looking for a diversified underlying. Unlike OARK, which gets its diversification through one ETF, ULTY trades on an actively managed basket of 15 to 30 stock picks, and people love this one because it gives weekly income. At number 8, we have YieldMax's TSMY with a solid 57% blended average performance. For this one, you should be bullish on Taiwan Semiconductor, which is up 36% over the past year. And with a PE of 25 below the S&P 500 average, it may not be overpriced and less likely to dump. Now this week, at the number 9 spot, YieldMax's GDXY fund makes its debut to our rankings with a blended average performance of 55%. We like this one because it gives exposure to gold, trading on underlying Van Eck Gold Miners Fund GDX. GDX is up 53% over the past year and has current PE of 21, which is the lowest of any underlying in this week's rankings. And lastly, at number 10 is Roundhill's YBTC fund, which trades options on underlying spot Bitcoin ETFs. This weekly pair boasts a respectable blended average of 46% annualized. It could be a great option for those who are bullish on Bitcoin and want to harvest income as Bitcoin continues to rise. Now, I want to give a special call out to number 19 Bitcoin, which fell from the number 9 spot last week. This is not an ETF and does not generate income, but I included it here as a reminder not to get so distracted by immediate income that you forget to protect and grow your wealth with the most advanced, inflation-proof, sound money, and Apex savings technology. Even with no dividends, its growth over the past 3 and 6 months earned a blended average performance of 22% annualized. But Bitcoin is up 92% from a year ago and currently available at an 8% discount from recent all-time highs. You can learn more about Bitcoin with my series, Why You Can't Afford to Ignore Bitcoin. And as always, I included top representatives from traditional ETFs based on the S&P 500 and NASDAQ 100 indexes. Even though almost all are at the bottom of our rankings, you might still consider them as conservative diversified plays. The best performer here was number 15, QDTE from Roundhill, based on the NASDAQ 100 stocks and with blended average performance of 30% annualized. To wrap up, I'll highlight some special groupings so you can pause and take a screenshot if you like. Here are our top 12 performers, all with blended average scores over 34% annualized. And here are the weekly pairs for those too impatient to wait a month between paydays. And lastly, here are the ETFs with diversified underlying if you want to avoid single stock risk. Well, I hope you enjoyed seeing this week's updated power rankings. Remember to do your own research to find the best funds suitable for your portfolio and your personal goals. And be extra careful when investing in Roundhill's leveraged weekly pairs at the top of our rankings. If you have any favorite ETFs that you didn't see in the rankings list, shoot them into the comments below and I'll check them out. Thanks for watching and be sure to like the video and share it out to those you love. Until next time, be wise, be safe, and stack sats.